We all know that feeling, right? Watching stock charts, chasing that next big winner, maybe even panic selling when things get rough.
Yeah, the siren song of the market, as they say. It can be pretty intense.
Exactly. But what if there was something steadier? Kind of like I don't know, a boring lottery win that just keeps paying out?
Mm.
I'm talking about dividend stocks.
Companies just sending you cash. It might not be flashy, but that consistency, that income stream, it's a really compelling story, especially lately.
That's exactly what we're digging into today. We've got this article, Buying High Dividends Hand Over Fist. Really interesting perspective.
Yeah.
And our mission basically is to pull out the core ideas, see why the author is so keen on this strategy, and help you figure out if it, fits with your own goals.
Okay. And the article, it kicks off by pointing out this big shift, how dividend yields are looking way more attractive now than they have for quite a while.
Right. It felt like finding decent income without huge risk was tough for a bit there.
It really was.
So this golden age for income investors, the author mentions. What's behind that? Is it inflation, rates, market drops, or...
Well, it's kind of a mix of all those things, actually. You had inflation running hot, central banks hiked interest rates in response, and then, market corrections pushed down stock prices.
Okay.
So when you have good companies, solid ones, still paying out their dividends, but their stock price is lower, well, the yield just looks better. That percentage return goes up.
Right. The math works out better for the investor buying in then. So we're not talking about those like 2 or 3% yields anymore.
Well, you can still find those, but the author's seeing more opportunities in the, say, 4 to 6% range, sometimes even higher, from quality companies.
And that's the key word, isn't it? Quality. This isn't about chasing risky junk yields that might get cut.
Absolutely not. The focus here is squarely on established businesses, companies with strong financials, decent balance sheets, and importantly, a history of paying and ideally growing those dividends.
Okay. The author gives some examples, right? What jumped out at you?
Well, Enterprise Products Partners, EPD, was a big one. What was the yield on that? Like 7%?
Yeah, 7.1%. And they mentioned 25 years of distribution growth. That's a serious track record.
It really is. It shows a commitment. And their business model, energy infrastructure with long-term contracts, it suggests a certain stability, like a toll road for energy, the author says.
I like that analogy. Predictable fees, less tied to shaky commodity prices.
Exactly. Then there was Realty Income, ticker O, yielding, around 5.8%?
Yeah, and the really remarkable thing there was the monthly dividend, over 650 months in a row.
Monthly? That's pretty attractive for income flow, isn't it? It really speaks to the stability of their net lease model.
Definitely. And then there was Altria, MO, an even higher yield, 8.6%. The author called it a legal sin stock.
Right. And the argument there, a bit controversial maybe, is that demand for their products tends to hold up pretty well, even when the economy slows down.
So the idea is consistent demand supports profits and dividends, even in a recession.
That's the author's take. These examples really frame that core point. There are opportunities now for decent income from established companies.
Okay, so good yield from solid companies. Then the article shifts gears a bit, right? To the power of reinvesting.
Yes. This is fundamental, especially for long-term dividend investing, taking those cash payouts and buying more shares.
The classic snowball effect. Can you walk us through the author's example? It really drives it home.
Sure. So imagine you put $10,000 into a stock yielding 6%. You just reinvest the dividends every year. The author calculates that after 10 years, even if the stock price goes nowhere, that $10 grows to over $18,000.
Wow. Just from the dividends buying more shares, which then pay more dividends.
Exactly. It's that compounding effect, purely from the reinvestment. It's not just the starting yield, it's how it accelerates.
And it gets even better if the company actually grows its dividend over time, doesn't it?
Oh, absolutely. So same scenario, $10, 6% yield, but let's say the dividend also grows by 4% each year. Now, over those 10 years, your initial investment could hit almost $22,000.
That's like 115% return without needing the stock price itself to soar.
Precisely. And like the author says, you're not constantly trading, not trying to time things.
It really underlines that idea of getting paid to wait, especially when the market's choppy, you're still earning something.
Which flows right into the next point. Why Wall Street might be overlooking these kinds of stocks and how that creates an opportunity for you, the individual investor.
This is where it gets really interesting. The argument that dividend stocks are, maybe a bit boring for the big players.
Kind of, yeah. They don't always grab the headlines like the high-flying tech stocks. Wall Street often chases that rapid growth, that next big thing. Performance metrics for fund managers often emphasize capital appreciation.
So these solid income generators might get neglected.
That's the theory. The author suggests this creates a potential inefficiency, a mispricing. Did you catch that analogy they used?
The luxury car auction, where everyone's fighting over the flashy sports cars.
Right. And maybe only one person notices the beautiful, reliable Rolls-Royce sitting quietly in the corner. You might get it at a bargain price.
So the boring dividend stock is the Rolls-Royce here. You could potentially buy a quality asset at a discount because it's not getting the same attention.
That's the idea. But, okay, let's address the elephant in the room. High yield often makes people think high risk.
Right. That immediate reaction, why is the yield so high, is something wrong.
And it's a fair question. Some high-yield stocks are risky. But the author pushes back saying, hey, growth stocks have their own risks too. Think about ARKK or WeWork. Big promises, big stumbles.
True. Risk is everywhere.
So with dividends, it comes down to due diligence, doing your homework. What kind of sanity checks did the author suggest?
Okay, yeah. First, check that payout ratio. You don't want a company paying out, say, 130% of its earnings as dividends. That's a huge red flag, right? It's unsustainable.
Definitely unsustainable. You want to see a comfortable percentage, maybe under 75% or so, depending on the industry.
And they also highlighted free cash flow, saying it's maybe a better measure than just earnings for seeing if the dividend is truly covered.
A very important point. Cash flow pays the bills and the dividends. And the third check.
Dividend history. A long track record of paying and ideally increasing dividends shows commitment and suggests financial stability.
Vital checks. And the author gave examples of companies balancing yield and stability. Brookfield Infrastructure, BIP, was one.
And Chevron, CVX. They mentioned this unspoken contract with shareholders at companies like that, and expectation dividends will continue.
Yeah, it becomes part of the company culture, the financial DNA, especially in mature sectors. So, okay, thinking bigger picture. How do these stocks hold up in tougher times, like recessions or high inflation?
This is a really strong part of the argument. During a recession, even if your stock price dips, that dividend income keeps rolling in. It can be a real psychological buffer.
Absolutely. Helps you avoid selling low out of fear. And the author points out something else interesting. Sometimes in a downturn, falling prices actually create better buying opportunities for these stocks. You lock in an even higher yield for the future.
Like those examples from 2008, Procter & Gamble. Johnson & Johnson, they kept paying and even raised dividends through the crisis.
Shows resilience. And what about inflation? How do dividend growers help there?
Pricing power, that's the key. Companies in sectors like consumer staples, utilities, healthcare, they can often raise their prices to keep up with rising costs.
Right. They pass those costs along, protect their profit margins, and can therefore keep growing their dividends. This helps your income stream keep pace with or even beat inflation.
Way better than just leaving cash in a savings account that's losing purchasing power.
Right.
The author mentioned PepsiCo and AbbVie as examples here.
Strong examples of companies with that ability. So beyond the numbers, the article touches on something softer, but maybe just as important: the psychology of dividend investing.
Yeah, the emotional side. Getting those regular cash deposits, it actually feels different, doesn't it?
It really can. It makes your investment feel productive, tangible. The author suggests it helps investors stay calmer during market swings, less temptation to constantly tinker or panic.
Like getting paid while the paint dries. I like that one. Your investments are working for you, quietly, consistently.
It's a great way to put it. Less pressure to chase short-term gains.
Okay, let's get specific for a moment. The author does share some areas and companies they're personally buying. Big disclaimer here, obviously. These are not recommendations for anyone.
Crucial disclaimer. Always do your own research. But seeing where someone puts their money based on their strategy is insightful. What areas did they highlight?
Okay, energy infrastructure again, EPD and MPLX, that toll road model.
Predictable revenue streams. Makes sense.
REITs too. Realty Income, O, and WP Carry, WPC. The author thinks maybe interest rate fears are already baked into the prices, making yields attractive.
An interesting contrarian take, potentially. The market might have overreacted to rate hike fears. What else?
The SIN stocks, again, Altria, MO, British American Tobacco, BTI, for that recession, resilience, and profitability.
Controversial, but the financial argument is there.
Then some blue chips for balance, maybe lower yield but reliable growers. Johnson & Johnson, J&J, PepsiCo, PEB.
Right, for stability and long-term dividend growth.
And finally, BDC's business development companies.
Mm.
Main Street Capital, Maine, Ares Capital, ARCC. They lend to smaller businesses, often pay high dividends due to their structure.
A more specialized area, definitely higher yield, but requires understanding their specific risks. It's quite a diverse list.
It is. It shows they're not just buying anything with a high yield, which leads to their buying strategy. What are the main points there?
Well, first off, it's selective. They're not just throwing darts. They emphasize watching those payout ratios closely.
Avoiding those red flags we talked about.
Exactly. Screening for actual dividend growth, not just a high static yield. Analyzing free cash flow and debt levels the underlying financial health.
And they don't just jump in all at once, right?
No, they mention buying in tranches, building positions gradually, which can help manage risk and average out your purchase price. And also using tax-advantaged accounts like IRAs or 401ks when possible for these dividend stocks.
That makes a huge difference with taxes on the income.
A very big difference over time. And they mentioned structuring things to create a monthly dividend ladder.
Ah, yeah. Picking stocks that pay in different months so you get income flowing in more consistently through the year.
Right.
Smart.
It really smooths things out. And it all ties back to the author's main thesis, really. Maybe we should think about winning in the market a bit differently. Maybe income is the new growth in a way.
Right. Challenging that constant need to chase the 10x return, the home run stock.
Yeah.
Comparing investing more to building wealth steadily, not gambling.
Yeah, contrasting it with trying to constantly time the market or find the next lottery ticket stock. The author sees the slow, reliable, unsexy nature of dividends as their actual strength.
And their personal reason. They want to get paid now, not just hope for huge gains someday way off in the future, seeing that cash hit the bank account.
There's a real tangible benefit to that.
So the next time someone calls dividend stocks boring, the author's advice is basically just smile and check your bank account.
Huh. Yeah, there's a quiet confidence in that regular income. It shifts the focus from market noise to actual returns you can use.
Okay, so wrapping up this deep dive. We've really unpacked the case for high dividend investing in today's market.
Sure.
We looked at the potential, the power of reinvesting.
The opportunities that might exist because these stocks are sometimes overlooked.
And crucially, the importance of doing your homework, checking payout ratios, cash flow, dividend history. We're not talking about blind yield chasing.
Definitely not. And we touched on how they can potentially offer some resilience during recessions and inflation.
Plus, that psychological edge, the calming effect of regular income, helping you stick to your plan.
So as you think about your own approach, maybe consider what role consistent income could play. What could getting paid to wait mean for your financial journey? It's definitely something worth mulling over.